Thank you. Okay, so my name is Ioanna Sari. I am the International Relations Coordinator of the Open University of Cyprus, and I would like to welcome you to today's session. We are very honored to host today and actually the remaining of this week Dr. Rafat Al-Jallad from the An-Najah National University of Palestine. And he will actually give 5 lectures that relate to banking and finance and enterprise risk management. And we're very happy to have him here. Before we start, I just want to give a short introduction to our visiting professor, who is an assistant professor of finance. He's an expert in business planning, feasibility studies, project management, business valuation, financial modeling, strategic corporate finance, and project finance. He has substantial academic and corporate experience, and he was responsible for managing several successful projects in companies such as telecom, real estate, and investment domains. Dr. Jallad has a PhD in financial engineering from the Wuhan University of Technology in China. He holds an MBA from the Free University of Brussels, as well as a master's degree in banking and finance from Ghent University in Belgium. He earned his bachelor's degrees in accounting and economics from the university he's actually working now, An-Najah National University. In addition, he's a certified management accountant and a chartered valuation analyst. He has published substantially in several journal papers, and his research interests include financial technology, Islamic banking and finance, corporate finance, financial engineering, risk management, and investment management. So we're very proud and honored to have him here today. And this first lecture, it's on artificial intelligence in finance and risk management. So without further ado, I will give the floor now to Dr. Jallad. Thank you.
Good afternoon, everybody. I'm honored to be with you here in the first day out of 5 days where we I'm not gonna to lecture you. I'm gonna to discuss with you and try to share our experience with you and gain insight from this discussion that guide our future research, future even teaching in this subject. Today's subject, in fact, it was planned to be the last one. Why it was planned to be the last one? Because it after the end of this discussion today, you will see that the artificial intelligence as a subject becomes a subject that enters in every aspect of finance. Not finance, but it's finance, accounting, everything, but it will concentrate on finance. Let's start by talking about what the agenda of today. We'll see what we mean by AI. What's artificial intelligence? Artificial intelligence, one type, or there are other types, or many types, or several types. And what are the types of AI? What do these types mean? What machine learning? And you start to, when we mention AI, you will have machine learning, deep learning, and what's machine learning, types of machine learning, challenge in machine learning, as well as the use cases of machine learning in finance. I will have some examples and we'll discuss with you other examples that are not mentioned here. If I start to say, what's AI? If I ask you what's AI, who would participate with us? Anyone who wants to raise his hand and answer this question, simple question. What do you understand when we say AI? In fact, artificial intelligence, it's simply, I'm not sure why this is not working here. Supposed to, okay. In short, AI, it is, we want the computer to think like a human being. What a human being can do. The artificial intelligence, it is a set of technologies that enable computer to perceive, learn, reason, and assist in decision making to solve problems in ways that mimic human thinking. If we look at this definition, we see that the main purpose of AI is to let machines think in the same way human beings think and can make decisions and reason and solve problems, many different problems, not just in finance, in all aspects of the life. Okay, this is the main theme of AI. AI, one type or several types? We have several types, in fact, of AI. We have what is called narrow AI or weak AI. What's narrow AI? In short, it is narrow AI that the machine specializes in making one task only. Okay. All, for instance, example, Siri, Google from Apple, Alexa from Amazon. Okay. Google search, web search. Okay. All these examples of machine learning, the weak form. Why? Because it can do only one task at a time. Okay. This is, if we think all or 90% of the AI that is today going on, it is for this type of the weak AI. The other type, we call it general AI. Okay, what does it mean? That we want the machine to do the same tasks as human, multitask AI or multitask machine that can think, that can do, that can reason, that can feel, make decisions, etc., etc., etc. This is still not well developed type till now. They try to have some let's say improvement, but it is not well developed right now. The other type, which is we call it super AI, that type of AI that in fact outperform the human beings. Okay, so this in fact also not outperform in what sense? In that can reason and make decisions and take actions and feeling that circumvent the human beings. Okay. What is machine learning? If we look to machine learning, we'll see AI, machine learning, ML, DL, deep learning. What is the difference? In fact, artificial intelligence is like the father for machine learning and deep learning, meaning that machine learning is included within the artificial intelligence. Okay, as we mentioned, artificial intelligence, we want to solve tasks in a way a human being is doing it. Machine learning is a tool. It is algorithms that allow computers to learn from example without being explicitly programmed. What does it mean? This is in fact a kind of programs, algorithms that are programmed in such a way it is fed with data, and the computer programs using different algorithms try to learn from this data, try to discover the patterns in the data and continuously learn from itself. Okay, continuously learn from itself. Deep learning, for instance, a kind of algorithm, what is written here in the bottom, random forest support vector machine. There are many different types of algorithms that are used to solve problems using machine learning. Deep learning, in fact, this comes from the biology. That's why artificial intelligence and machine learning, in fact, they started with the the intersection of different disciplines, not just computer science. Computer science, this is maybe it was the main tool, but it comes from biology, from different disciplines. In biology, they start to think, okay, as long as we want the computer to think like humans, how a human think? They start, okay, if we look at the brains, it is composed of many neurons. These neurons are connected with each other in order to make decisions. And they start to think, okay, let's have artificial neural network to solve the kind of problems in a way that mimic human behavior in a manner that is non-linear, let's say. Okay, that's why we usually connect deep learning with artificial neural network. Artificial neural network, we have input data, we have output, we'll see how it works, and we have multi-layer hidden inputs or layers. Okay, we'll come to this later and talk about in detail. What's machine learning? As we mentioned, machine learning, we want to use algorithm that make or extract features from data, and the machine start to learn, continuously learn and update the learning of itself continuously to solve a problem. This, in fact, solve many problems. One of them is predictions. What is predictions? We want to make forecasting, let's say, about the future actions, about the stock return. I want to predict the stock return for, let's say, the stocks for Cyprus stock for the next year. Okay, or this transaction is fraudulent or not? Is this transaction, credit card transaction, is it fraudulent or not? Is this email is spam or not? Image recognition, voice recognition, etc. All of this, we want to have some prediction task. This is, in fact, it's applied across many disciplines or many specializations, including healthcare, HR, tech, finance. That's why you hear today that I'll start to hear, not today, it's back for the last decade, about the fintech. Fintech, in fact, it's used technology with finance. That's why this issue is very important for us as a finance people to grasp this concept and try to understand how it's affecting our life, our companies, our economy in general, and what is the future for this trend. Learning phase. If we now look at the learning phase of the machine learning. Machine learning is fed with data, which we call it source data. And we have some terminology, training data. What is training data? We have a full set of data, and we divide this data into at least 2 subsamples. The first sample, which is usually the longest sample, we feed into computer, and as a training data, we want the computer to start to train itself using this data, using algorithm. Okay. Model then have output, which could be prediction, which could be classification, and try to see the pattern in the data. I have to mention here, usually in this, between the source data and machine learning, usually we have a step that's called a pre-preparation. What we mean by pre-preparation? Pre-preparation, usually the data comes from different sources. Not all of it is financial data. You can have data from social media, from Facebook, from we have qualitative, quantitative data, etc. Different types of data, and we have to make sure that the quality of data are of high quality in order for the computer to start to learn. That's we have missing data during the preparation phase. We have to deal with the cleaning the data, removing the or having some algorithm to treat the missing data or the noisy data, outliers, etc., during this period. So we have here the data, the machine learning, the algorithms with data, and we expect that the machine learning try to extract patterns, and after that come up with the output, which can be, let's say, as we say, prediction in the form of linear equation. This is the simplest way, regression. Okay. Then this is learning phase. We have three types of learning. We have what is called supervised learning, unsupervised learning, and reinforcement learning. What do we mean by supervised learning? Supervised learning, in fact, it's like this. We have the source data. We have the inputs. Let's say the inputs is x1. We denote it as x1, x2, okay, x3, x4. If we can someone give us an example for a linear equation that deals with finding that? Can we have x1, x2 for it? Sum and differential three-factor model. What says? Any volunteer? Fama French three-factor model, in fact, try to explain the cross-sectional differences in asset return or stock returns between different stocks based, and they come up with the model in 1992 that explains these cross-sectional differences and what is called three-factor, meaning that the return is explained by factor x1, factor x2, factor third, x3. They name, or the factor they discover is the x1, it is the x is return on portfolio, the same as CABM. The second is the value factor, which is high minus low. And the third factor is the size factor, which is low minus small minus big, sorry. And all of these x's are named, labeled, okay? And then they come say, okay, we want to result, the output, we name it also. We give it to you as algorithm. We told you that we have output that is named rate of return on a stock. So the computer is fed with inputs and outputs, data, historical data, sorry, and the algorithms start to learn from the input and map the desired output, okay? But this is, the output can be in the form, again, predictions, patterns, etc. In a training model, for instance, if we have the price history, this is okay, the price history, fundamentals, economic data for different, we want to try to predict the future return on a stock price. This is the same thing. This is supervised. Why it's supervised? Because we learn the machine in a supervised manner. We give it the input, output. It's like teaching a child, in fact. How you teach a child in a supervised form or supervised manner? You tell him, okay, if you do this, you will get this result. So if it is good thing, the result is good. Okay, you enforce this activity, this behavior. If it is bad, you say, no, it's bad. So the child start to connect, to understand the pattern, and in future behavior he wants to take, he start to have correlations between what he learned under the supervised form from what the new situation he has to take a decision on. Unsupervised. Under unsupervised, in fact, we have inputs, where I give him inputs x1, x2, x3, and I want him, I don't give him the rate of return. I want him to start to think and to find patterns in data and give me what are the expected results will be. Okay. Example of this, it is a classification problem related to our clustering problem related to market segmentation. You know that the market segmentation you learned during your undergraduate that we can segment the market by age, we can segment the market by demographics, we know the factor or what are the criteria, but in fact it is subjective way at the end that governs how we segment the market. Here we provide him with different inputs, segment, age, geography, education, etc., etc., etc. And we want the computer or the algorithms to start to segment the market based on various characteristics, based on the clustering, the degree of similarity between different groups, and come up with different clusters of the market. Reinforcement learning, in fact. Reinforcement learning, this is what is called sometimes stick and carrot, or reward and punishment. What does it mean? Here, under reinforced learning, we let the algorithm learn by testing various characteristics and deciding which one works best based on if he makes some successes, he will be rewarded. But if he made some mistakes, he will be punished. That he'll teach itself by trial and error. It's like letting a child without any supervision, and you want him to learn by himself. If he do something good, you will reward him. If he does something bad, you will punish him, but you will not intervene in the environment in which he's working on. This is, in fact, currently is applied under games. You have here that the reinforcement learning, machine learning, won or beated the world champion of Alpha Go game. Okay, it is used in gaming. Also, it is used in driveless cars. What is driverless cars? Driverless cars, it is cars that that drive itself by the computer without human intervention. And if he go to the right and become near to the wall, it's like a punishment. If it is stayed right, it is in the right road, will be rewarded. So it's learned by reward and punishment. Also, for sure, you see this movie for Nicolas Cage. It is where he had the ability, he was a magician at Las Vegas, and he had the ability to see the future in 2 minutes ahead. He can see 2 minutes ahead the future, so he can, if he wants to take any action, if he is punished, he will take another strategy and go. If he is punished, that was bad strategy, he will adjust his behavior. Okay, this is a kind of reinforcement learning. The third type, or the other type of the machine learning, deep learning is a subset of machine learning. So machine learning subset of artificial intelligence, deep learning is a subset of machine learning. Here, as I mentioned before, it's based on the neurons, okay? And we have different hidden neurons that try to find the patterns in the data and come up with the expected pattern or expected prediction for the data in hand, and also to generalize the data in the future. What influence the accuracy of machine learning? Different subjects or different things, quantity of data, number of features. What is the number of features? Number of features, how the data contains different features, different variables that can be grouped together sometimes, or can explain the data and help us in finding patterns in the data. What in machine learning, you have to be careful of two things. As I mentioned before, we have data. We divide this data into two groups, what's called testing. The other is called validation data. What is testing data? That we feed the computer or the algorithm with this data and tell him, okay, by running the algorithm, you need to find patterns in the data and try to come up with the prediction in the form of equation for the for our task in finance, for sure, prediction for the problem in hand. Okay. But what is the end result? Why I want the algorithm to do so? I'm not interested in explaining the history. The history has gone. Nothing will change the history, right? I'm trying to influence my future decisions. I'm trying to make informed decisions for the future. That's why I'm interested in a way that minimize the prediction or what we call loss function here. Okay. Loss function, what is the error of prediction? Is the difference between the predicted value and the actual value. And we know that we won't need to square this and take the mean squared error. Okay. But again, maybe I have a model that is perfect in explaining testing period or testing sample. 100%. He can explain the testing sample 100%. Here I run with the problem or challenge what is called overfitting. What is overfitting? That the data has learned and explained every movement in the testing data, but the validation or the generalization of this model for future data is very weak. Okay, that's why I have to be careful. If I have accuracy, a high accuracy in the data, this is not a good thing. I have, because the objective is to have a model or have a prediction that is can be validated in out of sample or out of what is called validation sample. The other things, what is called underfitting. What's underfitting? Underfitting is the opposite, that instead of having a model that try to explain, it take the shortest and the easiest way and have a model that is cannot explain the variation in the or the patterns existed in the sample period. Okay, that's why the model is not complex enough to explain the variation, and it is validation or it is prediction power is very low. Okay. In finance, how can based on this we have two ideas. We want a machine to think like a human. This is one thing. Machine learning, we feed the algorithms with data and train itself on the data and come up with patterns in the form of equation, whether linear, non-linear. This is another issue we'll talk about. Okay, and try to predict the output, the future value of the output variable or the decision variable. Okay. In what application can we use machine learning? In fact, we can use machine learning in different cases. In asset management, we can identify signals. What signals? We can identify signals. You know, signals we mean stock screening signals. When we screen data or screen stocks to be included in our portfolio, we have different fundamental technical screens, and we have many or a lot of variables that have been identified in the literature that will be responsible for having a high return for stock and choose for have a low return on stock. Okay, this is one way, asset management. Another way, in asset allocation. In fact, when we look to asset management, we have two broad decisions: asset allocation and stock selection. Asset allocation, as we will discuss in Letterman methodology later on when we talk about Black Letterman. Asset allocation is depends heavily on the estimated parameters. If I ask you, what do you think are the main parameters to be included in asset allocation decision? What do you think? Number one, expected return of the asset classes you want to invest in. Number two, volatilities, standard deviation. Number three, correlation matrix. If I ask you a question, from where we get this data, the estimate expected return? If I want to expect a return of for the next year for Cyprus stock, what do you, from where we get this data, do you think? In the chat, if someone, from history, simply from history. And the history is very noisy. And do you expect that the history? Yes, historical data. Historical data are very noisy. What's mean by very noisy? They have a lot of errors. And the expected return using historical data, there is no guarantee that will be repeated in the future. And if you have a historical return for the future, that is negative. If you have a time series for the stock for the last 10 years, 20 years, whatever, and you calculate the mean rate of return and it was minus 10%. What does this mean for the future? Do you expect that for the future that the investors are expecting, in fact, that the return will be minus 10%? Do you expect this? No, I don't think an investor is going to hold an investment that he expects to give him a return that is minus 10%, even minus 2%, minus 1%. I don't want it. Why should I invest in this kind of stock? Okay, that's why this is asset management. The second, credit intermediation. You know, banks. What is the business model of banks? Take money from depositors and lend it for investors or for borrowers. Sorry. Okay. So this is very nice and profitable business model, but it is risky. What kind of risk? You can lend the money for a client who won't repay the amount borrowed, right? So machine learning and artificial intelligence now is being used for making credit decisions, whether we lend this, whether it is this applicant is eligible for being granted a loan or not. This is used based on the extraction the features and learning from different demographic and financial variables related to the different applicants. Okay. Number three, algo trading. Algo trading, what do we mean by algo trading? Algo trading, this is not a new thing, by the way. It is an old thing that starts to be what is called robotic trading or robo-advisors. Okay. What is robo-advisors? It is you no longer need a human advisor financial to run your portfolio, or you don't need to call your broker to execute a trade for you. Now, a machine can extract signals to buy and sell, decide on the best trading size or a number of stock that you want to buy, and put the stop loss or stop profit, what's called take profit points, and execute the trading without any human intervention. This will be fast, emotionless. There is no emotion. Behavioral finance that say that we are, as a human, we are far from being rational in making investment decisions. So I take these issues and remove it from decision making. Okay. The four things that machine learning is helping us, it is what we call DeFi, decentralized finance, using blockchain-based finance through what is called smart contract. Also in risk management. Okay, this is in fact 4 areas that AI, machine learning, deep learning are helping us in finance in making informed decisions and also minimize the cost and increase the efficiency in the financial system. We'll take the first case of where we can use machine learning in making a corporate credit rating. Corporate credit rating, as you know, it is where you assign for a government or for a company a rating based on how it is credit worthy in paying its financial obligation, that is debt. Okay, whether it is short-term or long-term debt. We have 3 big credit rating agencies: Moody's, Standard & Poor's, Fitch Ratings, as you see. And I want you to see that we have in this rating 2 classes, major classes. One that starts from AAA and ends by Baa3 or BBB minus. This class is called investment grade securities. What is investment grade? It is of high quality. It's a little bit. As we move up in this rating, the credit quality increases, and when credit quality increase, what does it mean? That there is no risk of being exposed to default, right? The probability of default is very low. Probability of default is very low. So the extra risky premium will be for lending you will be low. That the cost of funding, the cost of giving you a loan will be lower than giving a loan for someone who is triple B minus, right? This is, but still in triple B minus, you still investment grade. Once you cross this threshold down, you go from triple B minus to double B plus, you will move to another area, what is called speculative bonds. What is speculative bonds? Speculative bonds, it is low quality bonds, which means that the risk of default is high. Okay, and this grade continue down until which means default. I want you to look at long-run benchmark default rate, the column here, that says that if you are investment grade in this area, high grade, you are expected to pay 0.1% risk premium over the risk-free rate of return. So if the risk-free rate of return, the government bond for the same maturity, let's say it is 10%, 2%, you are expected to pay 2.01%. Nothing. And if we look at the last risk premium in the investment grade, it is 1%. But once we cross the investment grade and moving to the non-investment grade or speculative grade, the risk premium increases from 1% to 7.5%. That's why a lot of institutional investors are prohibited from being invested in non-investment grade bonds. This is number one. And this is also why a lot of companies, they have a rating constraint when it comes to deciding on the amount of loan it wants or the amount of leverage it wants to have it in their capital structure. They say, okay, regardless of the increase in value, you tell me about when I increase my leverage from 10 to 50%, but this will violate my constraint that move me from AAA, let's say, to BB. Okay, so what's the task here? What's the catch? The catch we want here to predict the credit rating for a sample of companies. Okay, here we have, this is example from, I put the reference at the end. Here they have 10,540 observations from 1995 to 2016 of 1,400 firms. We want to distinguish between investment grade, non-investment grade. Okay, can we also distinguish between AA, AAA? Yeah. To keep things simple, they decide to just simple investment grade, non-investment grade. They have the model. The model, they say, okay, we have what we call it credit KPIs here, credit ratio, quick ratio, cash ratio, investment. What are these ratios? This is financial ratios from which we can have an idea about the credit worthiness of a company. Okay, if the company is credit worthy or not. And they have for speculative, the average for companies in the speculative grade and for investment grade, and t-test, as you see here, for the difference between investment grade and non-investment grade. That means how can this current ratio is statistically different between investment grade or non-investment grade. We see here it is minus 0.3.2, which is higher than the absolute value of 2. If they take the absolute value to 3, it's higher, as you know from your statistics course, though statistically significant. Okay, and then, sorry, the sample, which is, we have the full sample 10,540, is divided between train sample, which called training sample, and validation or testing sample. Okay, and we have the average. This is the estimated value for the training model, for sample model, okay, and train model for each of these grades. Here should be done at the very beginning. What should be done? The splitting between investment or between train data and validation data. This is the result. Well, they use the logit model. What does it mean, the logit model? You know from your econometric core, the logit model, it gives the probability of differentiating between different classes. Probability confusion, this is called probability confusion matrix. We are interested in this area to gauge the accuracy or the of the model. We are looking to the 37.7% and 39.5%. What this mean? This means that the model can distinguish, or the model can distinguish, it has the ability to distinguish between true investment grades when they are investment grade bonds or securities, and distinguish between non-investment when they are in fact non-investment grade. In other words, it makes correct decision. Okay, if, as you see, the model has 77.2% what the accuracy of this model, of its predictions. Then they have other algorithms to do what? To learn, to teach the model and have some results. As you call the precision, recall, F-test. All these are criteria for validation the model. The higher the ratio, the more the model is explaining the historical data. Okay. And try also not also explaining the historical data and also predicting the future value or the out of sample or test data. We have key nearest neighbor, decision tree, random forest, SVM, support vector machine. You see that logit model here, it has 77.1, but we have key nearest neighbors 79 here, 79.2. Okay. As you see that we have other models or other algorithms that give us better results than the logit model. Therefore, we can rely on, let's say, on the k-nearest model to give us better results, or because in the recall it gives us 84.4, or we can rely on random forest, which is give us better results than the logit and the decision tree algorithms. AI in trading and investment, as I mentioned, we have a lot of data that are extracted from social media to get the sentiment of the investors or the sentiment of the clients. Okay, in finance we are interested in sentiment of the investors in the market. Okay, this has been explained. So we have companies here that are using AI in their trading: Robinhood, AlphaSense, Betterment, Weatherfront. Wealthfront. Wealthfront is using Black Letterman model in their asset allocation, machine learning, in order to find the expected return using Black Letterman model. Acorns. Risk management. In risk management, this is a hot area, in fact, for the AI is helping in companies, banks, different institutions in making decisions in the area of risk management, in the area of predictive analytics. As we mentioned, we want to predict the future. Fraud detection, cyber security, NLP, natural language processing, risk assessment. Okay. Fraud detection, this is, we mentioned, improved accuracy. Okay, what is the advantage of AI in finance? Before coming to what is the advantage of AI in finance, other areas where we can AI help us, as we mentioned, in factor investing. In factor investing, we want to select securities based on different factors, such as size factor, such as value factor, profitability, such as momentum, etc., from the factor that has been outlined. So we want to see how, if we give the data or they give the model different factors, X and expected return, using artificial neural networks and different hidden layers of neurons, how can the model or the algorithm teach itself in order to give us at the end, after many different layers that are pre-assumed and given to the model that we want 5 or 6 or 7 layers to be hidden, to give us a prediction model. Okay, so this is one area. In addition to the asset allocation, we'll discuss it in the asset allocation in the Black Letterman in the I think the 5th day. Well, advantage of AI in finance: improved accuracy in financial analysis and decision making. This is we talked. Enhanced efficiency in terms of cost saving and time saving. Real data processing and analysis. Personalization. This is very important thing. Personalization and customization of financial services. You know, as a part of the asset of the portfolio management process, is to understand your client, which is called in banking terminology, know your client. What is know your client? You have to understand what is the objective, or what is the return objective of your client, and what is the risk tolerance of your client before deciding what is the optimal asset allocation for your client. Okay. AI, in fact, is helping us in personalization our services and providing clients with personalized services with lower cost. This is not in asset allocation. This is in banking through your chatbot. Okay, chatbot try to teach chat with you and try to provide you with personalized solutions, personalized answers to your problems, etc. Reduction errors and fraud. This is another advantage of AI. Thank you. Any question? I'm ready to answer your question if you have